Hey, good morning, everybody. Appreciate you checking in. Um, sorry I missed the last coffee with Kirk. I was pretty sick. Uh, was feeling really bad. Went to one of those minute clinics or whatever you want to call it. Did a COVID test, didn't have COVID. They just thought, well, you just have kind of a cold or a flu that's going around. So, I was kind of in bed, and it kept getting worse, getting sicker. And it turns out I actually had pneumonia. So it took a few days. I finally went back, to a doctor. Said, look, what's going on here? Like, oh yeah, you got pneumonia. You got it pretty bad. So it's kind of in bed for a week or so. If I've got a lot of emails to catch up on still. So if you sent me an email, I'm going to get to it. I promise. I'm just working through them. Got a lot of other things, other planning stuff that was going on. So, trying to work through everything. So sorry about that. And my voice is probably going to be a little off today too. It's still kind of coming back. So I'm going to keep it a little bit shorter, just because the voice is bad and all that. And what I wanted to talk about last week, and I'm going to talk a little bit about this week, is just kind of, why do I always talk about bonds? Why am I always talking about bonds? Bonds aren't fun. They're not sexy. Shouldn't all be focused on stocks. But the reality is, bonds, especially like the 10-year treasury, everything's anchored to that. Everything is. I've always said it, the smart money's in the bonds, not the stocks. Bonds are the big brother. So if you really want to kind of understand what's going to happen with the economy and stocks and real estate and everything else, you got to look at bonds. You got to understand what's happening with bonds. So we'll talk a little bit about bonds. And then I'm going to talk about this week. This week was a good week for the markets, stocks and bonds, both up. And why was that? We'll talk real quick about that. And then I'll finish talking a little bit about kind of bigger picture on the stock market. But it's not going to be quite as long as normal. So let me just kind of jump right into some slides here and we'll get rolling. So again, agenda for the day, why bonds matter this week in the market, and then sort of some bigger picture stuff for the stocks. So this is a real recent view of the U.S. 10-year treasury. Now, the 10-year treasury is kind of like sort of the benchmark for the whole financial world. Everything's in some way tied to the 10-year. So, obviously people know that mortgage rates are tied to the 10-year. So that means your HELOCs are as well. Anything tied to real estate, commercial real estate loans, everything's sort of tied to the 10-year. But it's also a big factor in stocks too, because you're always making a decision on, do I invest in bonds or do I invest in stocks? And you can kind of see how volatile the U.S. 10-year has been over the past month. This is just October. Now, when you have something that's supposedly kind of a risk-free, it's a government bond, so it should be pretty risk-free, but it's also the benchmark for everything else. This kind of volatility is really, really dangerous. And the reason is it could cause some dislocations in the market. I mean, we briefly touched 5% this month, and now we're back down to 4.66. Now, that doesn't seem like a huge move, roughly 34 basis points or 0.34%, but it is. It's a massive move, and got down as low as 4.55 this month. So that is a very volatile 10-year movement, and it's one of those things, like when stocks are moving up and down that fast, people notice it. When bonds do it, they should really take notice, because it's kind of showing you that the smart money really doesn't know what's going on. um, which is a little dangerous. And it also is going to affect every asset class because of its volatile movement. Now, this chart kind of overlays two different things. The red is the biggest thing to look at. It's called the MOVE index, and it just measures volatility in treasuries. And you can see it's at levels we haven't seen since the financial crisis of 2008. So we got just a massive amount of bond volatility. Now, the white line is just the difference between high yield, or what we also call junk bonds, high yield bonds compared to treasuries. And it's still pretty low. Usually when you see this kind of volatility, you start to see the spreads between 10-year and high yield corporates go up, or junk bonds. So all that is it's a difference between what you could get on a 10-year treasury and what you should get on a junk bond. And you think normally you're going to get a much higher return on the high yield as compared to, high yield compared to the treasuries, because there's more risk. So we're seeing a massive amount of volatility in treasuries, but we haven't seen the spreads yet in the typical widening of the spreads between high yield and treasuries. So that's something to watch. So it could just mean one of two things. It could mean that people are nervous about treasuries. I think it's because we're issuing so much debt, so that maybe there's just naturally some more volatility in treasuries. It could just be people are going out for more yield and trying to go into the corporate debt. Now, the problem is usually, as you can see, when bond volatility gets this high, typically the economy is struggling. So you see high yield spreads get even bigger because the risk in high yield is much higher. So it's something to kind of watch, but this volatility is just not natural in the bond market. And rates have risen so fast, they've never moved this fast ever in history. Even when Paul Volcker was in charge of the Fed way back in the late 70s, early 80s, and he just crushed inflation by raising rates. So, the fact that we're not at 13, 14% like Paul Volcker got us to, well, it's only because we started at 0% rates, and now we're up, darn near 5.25%. So, you really have to watch the bond market. This thing, it's unprecedented what's really going on. And we talked about it. It's been inverted for the inverted yield curve. So short end has been higher yielding than longer term. And it's been doing it for the longest period that we've ever seen. We started to see it kind of what we call steepen or kind of normalize as the 10-year and longer dated bonds started to go up this month, closing in at 5%. But then they've since gone back and inverted more just recently. But again, to put it in perspective, we're really experiencing unprecedented periods in treasuries. This is looking at the U.S. 10-year treasury going all the way back to 1928 and what kind of return you got. So the return is could be capital appreciation plus the yield on the bond itself, obviously. And in most years, the yield on the bond was the return that you got. Now you can see this is, if 2023 finishes off like it's been, this is going to be the first time in our nation's history that we've had 3 down years consecutively in treasuries. That's never happened. I mean, we've had periods where you've had 2 years in a row, and you can see there's several 1-year periods where they've lost money. But even in the late 70s and early 80s, when Volcker raised rates like they were, you think that we would have had several years where you lost money in treasuries. But again, the yield at that time was, double digits. So you're getting a large yield, which helped offset some of the loss of capital as he raised rates. And remember, when rates go up, the principal of your bond goes down. It's kind of counterintuitive. So, and the reason again is if you were going to try to sell your bond and you had a bond that was yielding, say, 3%, and the current yield is 5%, nobody's going to buy your bond at 3% and give you all your principal back. You're going to have to reduce your principal to give them a current 5% yield. So this has really just been unprecedented. And this is why I keep watching bonds and why it's really just amazing to me what's going on, just the amount of volatility, unprecedented losses that we've seen. And the only other time we've ever probably seen close to this much volatility and losses would probably go back to the Civil War. They don't have data on that, but there's some rudimentary data. At that time, they didn't know if the U.S. was going to be around. So investing in a U.S. Treasury at that time was essentially a junk bond. But even then, they don't have specific data year by year. But since the Great Depression, this is the worst bond market we've seen, a 3-year effect. It's just never happened. So, I mentioned the 10-year is sort of the benchmark in which everything else is sort of priced. All risk dynamics that you look at. If you're an investor, you always look and say, what could I get in the 10-year? And then you start to make your decisions from there. Should I invest in stocks? Should I invest in real estate? You have to look at kind of what your generally risk-free rate is. And then you can try to decide if it's worthwhile to take more risk. So bonds do have an effect on the stock market. What this is looking at here is what they call the S&P 500 forward earnings yield minus the 10-year treasury. So what it's trying to do is say, are you better off investing in the stock market or are you better off investing in treasuries? And the earnings yield is essentially the reverse of the price to earnings. You'll always hear me talk about price to earnings. Take a price of a stock, let's say it's $40 a share, and it's got $4 of earnings. So you divide 40 by 4, and you get a price to earnings of 10. So in theory, what that will tell you is if you get $4 of earnings every year, it's going to take you 10 years to get your money back. Now you hope that the earnings grow a little bit faster so that you can get your money back sooner. But that's generally what you're looking at. The higher the price to earnings, the longer it takes you to get your invested capital back. So the S&P earnings yield is the inverse of that. So you're going to take the earnings, which is $4, divide it by 40, the current price. And then that's what you get, the 0.10 would be your earnings yield. And then you add on top of that the dividend yield. So if you get in a dividend on the stock, you'll also add that. So that's what they're talking about forward earnings. And what this chart shows you is that right now, essentially, you're better off buying a 10-year treasury than you are investing in stocks. And there are periods you can see if you go back, if you'd bought in 2009 or something like that, at that point you got a really good S&P 500 earnings yield compared to the treasury. So there are periods where, when this is very high, that's when you want to be invested in stocks. But right now it's awfully low. So you're really hoping that either rates come down rapidly if you're investing in stocks, or somehow, earnings are going to, skyrocket up. And it's not even right now. It's not even just the 10-year treasury, but triple B, which is, it's not junk bonds. It's just below investment grade bonds. So, you're just below the A-rated bonds. But even they're showing that they're kind of a more attractive place to be than the S&P 500 based on the S&P 500 earnings yield. So kind of interesting to look at that. But it's not just stocks that bonds affect. It's real estate clearly is a big one. And this is looking at corporate real estate, not your private home. So in corporate real estate, commercial real estate, they use what they call a cap rate, capitalization rate. That sort of tells you what you're going to earn as an investor on real estate. So you basically take, all the income and then you subtract out essentially all your expenses. You're not going to do, mortgage prepayment, anything like that, but mortgage interest, taxes, repairs, all that good stuff. And so you just have to look and see right now, am I better off going into a 10-year treasury, or do I want to take the risk and invest in real estate? So astute real estate investors are going to look at this and say, well, why if the capitalization rate right now is 4.5, 4.6%, but I can get that in a 10-year treasury, why would I take the risk of investing in real estate? Because there's a lot of things that can go wrong with real estate. You can get a bad renter. You could get a renter who's not paying. You could have an assessment on taxes. You could have a big repair that comes up. A lot of things, there's a lot of risk with real estate. So you start to say, is it worth the risk? I can get the same return on a treasury, which a lot of volatility right now, but typically, historically, it's sort of what they say the risk-free rate is. You can invest in that, and that the government's at least going to pay you back. So there could be inflation, which derails it, but for the most part, that you're going to earn essentially the same thing that you would if you compare it to going into real estate. So this starts to have a big impact on the economy when you get rates this high. And there's definitely like sort of a lag effect. You get money printing, then you get inflation, then you start to have kind of a reduction in that liquidity. And then finally, you start to, if it's a big enough liquidity drain, you get a recession. And especially when rates have gone up like they have. So this just shows you that, global liquidity over the past 10 weeks, it's really dropping pretty fast. About $1 trillion has dropped. But since the peak in 2022, we've had about 4.2 trillion in liquidity leave the markets. Now that's still sort of pales in comparison, considering how much they pumped into the economy at COVID. You can see from COVID to the peak in 22, about $11 trillion came in. So we really haven't even had half of that leave. So maybe that's what's kind of keeping the markets levitated, keeping things under control. But we clearly see that the liquidity is leaving. Now, liquidity is just sort of like the oil in your engine. If it's nice and liquid, that thing's moving. It's moving. You don't have the friction. But when you get too low on oil, you start to get friction. You start to have problems somewhere in your engine. Somewhere you're going to overheat. Excuse me. And you can still see even from 08 or 09, they pumped in 12 trillion. So from 09 until 22, about 23 trillion of liquidity pumped in. But that liquidity is coming out. Now, will it continue to come out at the same pace? I don't know. And I have a feeling that if we really do go into recession, obviously that's going to change and they're going to start pumping liquidity like crazy. But at least right now, the global central banks around the world, not just the Federal Reserve, but all of them are starting to pull liquidity out, with the exception of Japan and China, which have their own issues that are going on right now. And this liquidity, you can see one of the biggest things is the Fed's balance sheet. We've talked about this extensively, but since '08, they've really gone from $800 billion balance sheet to now, they reached almost $6 trillion. That's a huge move up, but they are selling the assets on their balance sheet. So they brought all these assets in, about over $5 trillion of assets, and then put $5 trillion of cash out. So now they're starting to reverse it. They're taking the assets that they've got and they're selling them, and they're pulling cash out, and that's continuing, and it's going to continue for a while. A lot of people don't think the Fed will slow down, but they are, and they're continuing to do that. And it's happening at banks as well. You can see banks' balance sheets, the amount of deposits that they've had have gone down. Now, they went up massively during COVID because of all the government stimulus, but we're starting to see those balances come way down. That pulls liquidity out of the markets. And this can also be seen in the money supply. So the money supply, while it certainly just exploded during COVID, so compared to how fast it's gone up, it still hasn't come down nearly as much, but it is coming out. And that's going to cause dislocations. And it could be one of the big reasons we're seeing volatility in the bond market. Just as liquidity comes out, everything is going to start to get more volatile. And again, as I said, it's not something that's just contained to the United States. We're also seeing liquidity come out here. This is just a chart of the Eurozone area. So their banks are pulling back a lot. So their lending is dropping like a rock. Okay, so I could get into it more, but basically the reason I look at bonds a lot is it's the bigger picture, the smart money, they say. So with lots of volatility and the fact that they've gone up so much, which is causing a liquidity drain, and it's going to be exacerbated, this liquidity drain, by the amount of debt that the government's pumping out too. So at that point, if there's that much debt coming out from the government, investors have to say, where am I going to put my money? And if they're putting in the treasuries, they might demand higher interest rates for that because there's less liquidity. They don't have as much liquidity as they normally would. So this week was an interesting week. The stock market was up about 5%, and bonds rallied. So the treasuries I showed you before went from almost 5% down to 4.66%, a huge move. So everything kind of rallied, and this was a CNBC headline. It's like bad news for the economy is good news for the stock market, as long as it doesn't get too bad. So that's what we're kind of seeing. The economic numbers are starting to get pretty bad. Now, it started off, the Federal Reserve held steady on the interest rates. They didn't raise their interest rates. So the market loved that, thinking, well, maybe the Fed's done. Maybe this increase, this massive, unprecedented increase in interest rates was just a one-time thing. And it's over. It could be. That could be the thing. But then also we got a lot of data this week that didn't look really all that good. So the jobs report, they expect 178,000 jobs, is only 150K. On the establishment survey, that's the main one that gets all the press. The other thing is they revised down the past 2 months as well by over 100,000 jobs. So, the employment data just didn't look all that great. Unemployment rate ticked up to 3.9. That's not a big issue. I mean, it's still a really good rate. 3.9% is pretty much considered full employment. But average hourly earnings are dropping. They're not growing as fast. The other big thing is services are finally starting to slow down. Anything below 50 is a contraction. So services still growing, but it's well below the expectations on it. Although earlier in the week, we did have a much better durable goods order. That's one I've been watching, and it's really been getting bad, but it was really good this last month because there were apparently a lot of aircrafts were ordered. So, Boeing is probably going to be pretty good stock here for a little bit. So they did have a jump because of aircraft, non-military aircraft orders came in. So that's good. But a lot of the data is just not looking real good. And so the thought in the markets is, all right, the bond market's got a little bit better because thinking, well, Fed didn't raise rates, and with this data, they're not going to be able to go any higher. And then stock market is desperately want to get back to like 0% interest rates, get that liquidity in there, and so the markets can go up. So they like the bad data, and again, as long as it's not too bad. Now, we've talked about this in the past. There's two ways that Department of Labor looks at unemployment. First one's what they call the establishment survey. This is where they're looking at, tax receipts. They're looking at all the states and Federal Reserve areas, like did unemployment go up, did unemployment go down, how many people are on payrolls, all that kind of stuff, and they put together that, they also try to figure out how many new small businesses were created versus how many small businesses were shut down. So they try to factor all that in. It's a real messy process. But the other way that they gauge what's going on with unemployment is called a household survey. And this one's a little more straightforward. They just create a random, calling households. Do you have a job? Do you not have a job? So the household survey actually lost 348,000 jobs last month, whereas the establishment survey gained 150. And we talked about there's been a massive difference between the household survey and the establishment survey. And part of that reason that the establishment survey, the one that gets all the press, has been much better than the household survey. And part of that reason is the household survey just says, do you have a job or do you not? So if they're employed, are they fully employed? If they are, then they're an employed household. But the establishment survey, if somebody has to take two jobs, it looks like there's more jobs being created than there actually is. So the household survey just says, okay, this person's working, they're employed. That's one job. It doesn't matter if they're working two or three jobs. It's just, all right, they're fully employed. The establishment survey would look at that. If they're working three jobs, so one person, but they're working three jobs, you see, well, there's been three jobs created. So it makes it look like there's three people who got jobs. So we have seen a shift from full-time employment to part-time employment. Part of that could just be people wanted to have more flexibility in their life. It could be retiree, people who are working full-time as, got to 65 and now they're working part-time. A lot of factors go into that, but there's a pretty clear trend that there's a lot more people working part-time jobs as opposed to getting full-time jobs. And this month was also a little bit off, because of the UAW strike. There's about 50,000 union workers who at one point during the month, was on strike and weren't employed. So we'll see. But, jumping back to bonds here real quick. This is why I keep saying it just looks like there's a slowdown coming, and why I'm sort of been really conservative. The leading economic indicators are still, dropping, and, it hasn't manifested itself in the full economy yet, or the stock market either. But, the numbers continue to get worse, and, bonds are, it's hard to say if bonds are pricing a slowdown or not, just because I think there's so much volatility with it. It's hard to really say what bonds are telling us, and we won't know until probably later. It's one of those, you look back in the rear mirror and that'll tell you what's going on. But it's definitely having an impact. When you have higher rates like this, it eventually slows in every department. Real estate's going to slow, and not just the price of real estate, but Talk to a realtor. They're probably having the worst year they've had in a long time. Same with mortgage lenders. I mean, mortgage lenders are really hurting. I had a friend of mine who, put out to get a quote on some home equity. They're doing some improvements. He said it's been unbelievable how many people reached out to him. Like he said, it's over 200 lenders. And it was just crazy. So they're just desperate, but higher bond yields end up manifesting itself in all kinds of different ways. And it starts to slow down the economy. Okay. And then the last thing I was going to talk about is just to give you an idea of the difference here on what's really going on with the stock market. So the only thing that's done well this year really has been tech. Tech's done great, mostly, and I'll show you in a second, due to 7 stocks. S&P 500 right now is up on the year about 10%. But then if you dig a little deeper and you look at the Russell 2000, which is small company stocks, if you look at the micro cap stocks and mid cap stocks, I mean, they're all down for the year. Usually, if you have a really robust economy, the smaller companies tend to lead the bigger companies. Bigger companies are a little bit, they're like aircraft carriers. They don't move quite as quickly. Whereas smaller stocks, obviously, they are really tied to the economy. When the economy's doing well, they're going to do quite well because they feel it first. A big company like Exxon or Procter & Gamble, they're selling their products no matter what. There may be some deviation one way or another, but, really small companies going to have a big impact as the economy improves. They're going to see it quickly. And as I mentioned, the top 7 stocks right now have contributed really the vast majority of the return for this year. If you take those 7 stocks out, stock markets actually, the rest of the 493 stocks in S&P 500 are down for the year. So it's a crazy year. And a lot of these, I've talked about, I'm not going into these stocks because for the most part, they're just so overvalued, especially NVIDIA. I mean, NVIDIA is the darling right now, but it's trading at 40 times sales. And that's just absolutely ludicrous. That's sales. It's not even profits. So when you talk about profits, it's, 200 price to earnings. It's just ridiculous. So this just doesn't hold. And kind of give you an idea of how, when you get these dislocations where so few stocks make up a huge part of, relative to the economy, they make up a huge part of the GDP. Go back to 2000 and the top 10 stocks, you can see, made up about 28%. The value was about 28% of the total gross domestic product, the total size of the economy. And then we had the 2001 recession, and that kind of normalized everything. Right now we're over 35% for the top 10 stocks. You just can't hold that forever. It just doesn't hold. It's not a natural way for the economy and the markets to function. So basically, it's saying these 10 stocks today have a value of 35% of our total gross domestic product. And when you remember that the gross domestic product is all economic activity, so it's all small businesses, which is the majority of our economy, small and mid-sized businesses. So it's just such a dislocation right now that don't know how long, it can last a while, but it doesn't last forever. It just won't happen. And, I always use a kind of Apple as the poster child. Apple is not the same company that it was. If you'd have bought it in the early 2000s, I mean, it was completely growth, new products, massive audience that they're able to penetrate. Now it's not so much that. Now it's new. They just put out new generation of iPhones or their computers and things like that, but nothing that's revolutionary. Nothing that's going to completely open up new markets. When you have a company that's worth over $1 trillion in order for it to grow like it used to, I mean, the sales growth has got to be just absolutely massive. And when you get that big, it's awfully difficult to do that. Now, Apple is still a massive generator of cash flow, and that's what you like as investors. But its current valuation and what people project, people are still looking at it as it's going to be one of these companies that grows, 10, 20 times what they paid for it. It's just not that company anymore. So, when you look at the bottom part here, shows the revenue growth, and they're actually past 3 quarters, they're not growing at all. They're actually shrinking as far as revenue. And at the top just looks at its enterprise value relative to its sales. And it's just not there anymore. Now, it's still going to be a good cash flow generator. But if it's going to be a good cash flow generator, it generates about the same amount of cash flow that ExxonMobil does. But Apple is, I think, 4 times the value of ExxonMobil. So if it really becomes just a cash flow generator, it's probably going to be valued more like ExxonMobil than a fast-growing tech company. So that doesn't really bode all that well for its stock price, at least on the upside. But you're still going to get some great cash flow. You'll probably start to see Apple become one of these companies that pays more in dividends. So, but it's a different world. Okay, now let's finish off with the disclaimers. Try to make sure the information presented is accurate. Make sure you talk to a financial planner. Yada yada, all that good stuff. So, okay, let me turn that off and see what we got questions wise. Do you really think bonds will recover in time? That's hard to say. Honestly, I don't think bonds are going to continue to lose value because they're starting to affect the economy. It's starting to get in there. So there's kind of a ceiling with it. Although, and I want to always put this caveat, I mean, the way the government's spending money, so far, you have to think that they're demanding a higher interest rate because of the amount of debt that we're undertaking. So in a normal situation, under normal spending in the government, I'd say we're probably capped where we're at. And then we could see bonds do really well if we go in a recession, because money will leave the stock market and run to bonds. And the reason that it'll do that is because they figure the Fed will drop rates, and the Fed probably will if we go in a recession. So if rates start to come down, you could start to see some really good capital appreciation in bonds, so long as bond investors don't feel that they need a higher interest rate due to the amount of massive debt that's coming out. There was an interesting quote. Stanley Druckenmiller is a famous hedge fund manager, and he basically went right after Janet Yellen, said she ought to be removed as Treasury Secretary. And the reason was, when rates got to zero bound, consumers refinanced their debt, their mortgages. Corporations did as well. They took advantage of those low rates, but the government didn't. The government didn't issue, instead of issuing more 30-year treasuries at 2%, they just kept a lot of it at short term. And then when rates went up, now we're stuck. And our interest payments are going to be massive because they didn't take advantage of low rates. So do I think bonds will recover in time? I don't know. I think they'll probably kind of stay where they're at, but I'm not sure. Do you really know that the government's going to pay you back in 10 years? They'll pay you back. The question is what's the inflation rate going to be? So if the inflation rate's above what you're getting paid back, you're losing money on a real basis. That's the problem. That's the big issue. So, and the thing the markets this week love the fact that bonds, that the Fed held. They're thinking rates are going to come back down. But the problem is we still have 4% inflation. And I didn't get into it this one. Maybe I'll do it next. But if you look, food inflation is still going up quite a bit all across the board. The funny one is orange juice concentrate futures are at all-time highs. If you remember that movie Trading Places with Eddie Murray and Dan Aykroyd, that was what they focused on, was orange juice concentrates. So the big thing was this week is where's Beaks, where all that, because orange juice is like all-time highs, but so is coffee, so is cocoa, all that stuff. So we still have inflation at 4%. So the Fed's going to be stuck where they're at for a while because they still want to get the 2% inflation, and we're not getting there. We're kind of sort of stuck here at 4%. Now, 4% is not bad relative to where it was at 9-10%, but it's still, that's on top of the 10%. When inflation rate goes to 4%, it doesn't mean its costs are coming down. It just means the amount you're spending is still going up, but it's just not as fast. Good point. Some of those top 10 stocks don't actually make anything. And Rob says better Boeing, and that's true. Boeing has to be getting some good orders here, based on what came out this month. So, and that's how these higher yields also affect the stock market investing. You can't invest, when rates are really low and there's a lot of liquidity, you can invest in stocks that have a good story, right? You can invest in things that have potential. They don't have earnings, but you think, oh, okay, because they have liquidity, because they can get access to capital, they have more of a runway before they get the earnings going. When you get rates this high and now liquidity comes out, you need to invest in companies that generate a lot of cash flow, that have dividends, that have good reliable earnings. Growth versus value we talked about, but this year that hasn't been the case. Value stocks have actually struggled this year. Doesn't really make a lot of sense, but that's what you want for a longer term investor. You need to have companies that are really producing. So what's the new Apple? Well, that's a great question. Everybody talks about AI, but AI is sort of like what the internet was in the late 90s. Clearly it's going to be a big player. It's just who's going to get there. And there's going to be a lot of casualties along the way. If you look back at the internet, when the internet came on, everyone's like, well, invest in the internet because it's the future. And it certainly was the future and still is the future. But there are a lot of companies that just could never produce that cash flow. And when you look at AI right now, it's awfully hard to tell who's going to be the one to do that. It'll probably be one of the big guys, maybe a Google. But here again, bigger guys move slower. So I don't know. It's probably something on the AI front would be some small company that's going to do that. That's the only thing I could probably think of. But I don't know at this point. And there's going to be a lot of, like I said, a lot of small AI companies that are just going to get washed up. I follow this thing about AI and how to use these tools. And I mean, there's a million startups that are coming out with some great ideas, but who's going to be the one that actually gains traction? I don't know. At least not yet. There's really nothing that's showing it. So is the trend in bonds the new normal? It could be. It all depends on inflation. The Fed was lucky from 2008 until really through COVID that the amount of money that they printed and put out there up until COVID never really manifested itself in inflation. So once we had the money printing in during COVID, it got into the hands of consumers and created this inflation. And you can also argue that the inflation happened due to, supply side issues. That's absolutely true. So I think it all depends on what inflation does. And I still think we're in a period in the next 10 years where we're going to have inflation. And I've talked about it. Underinvestment in commodities is a big factor. So energy is going to be costlier. The second thing is we finally started to realize we can't have all our manufacturing in China. So we're starting to, instead of outsource it, we're insourcing it now, which long-term is good for us. Long-term, it's good to have at least supply chains that might be in South America, Central America, or here in the U.S. It's also good for jobs if we have more manufacturing. But it's also short-term inflationary because you have to build the plants. There's probably going to be higher cost of labor. So that's going to be inflationary. So it's painful short-term, but longer-term, I think it's good. Why didn't the government take advantage of low rates? I don't. That was Druckenmiller's whole point. Why didn't they do that? I don't know. Mismanagement is the only thing we can think of. Not only were they not issuing longer dated bonds and trying to get low rates, but they were actually using the reserves that the Treasury had as well. So we actually have sort of a savings. The Treasury has a savings account, and they burned that thing up. So there's no savings now. So now we are completely 100% debt-based in order to fund our shortfalls beyond our tax receipts. So the guy, Druckenmiller, a good point. He's like, Yellen should be gone. That's absolutely ludicrous what she did. Okay, so with the current, this is a good question. Current economic conditions and returns in most vehicles to be minimal or down, is gold and silver, would it be a good option long-term since the feds are going to continue spending us into oblivion? It should, yeah, absolutely. Now, in the short term, you could see, well, gold and silver are doing pretty well right now, especially gold. It started to drop, now it's coming back. But if the dollar gets stronger, so if the world economy continues to struggle, the dollar will probably get stronger, just as it did in 2008, just as it did during COVID. And when the dollar gets stronger, that is sort of a headwind for gold and silver. But you're right on the longer term. Obviously, the dollar, all currencies around the world are going to be debased. So when you have that situation, all physical commodities are going to do well. Sorry, voice getting a little raspy here. So all physical commodities are going to do really well, but clearly the ones that are sort of tied to monetary, like gold and silver, will probably do quite well. And physical bullion, yeah, the physical bullion, absolutely. Okay, then Rob says United is expanding their fleet. Yeah. The one thing that's been amazing with this, I can show you graph after graph of how people are struggling. Even Target came out today and said people are starting to even cut back on groceries. They're seeing a cut back on groceries. Everybody's struggling, but the one thing that people are still spending a lot of money on is travel. I didn't put it in this. Maybe I'll put it in the next Coffee with Kirk. TSA numbers, they track how many people have come through. And airlines are still just booming. Their stocks are in the trash, oddly enough. But people are still right now at least traveling quite a bit. I don't know if it's due to COVID, like people were locked down for so long that they're traveling come hell or high water, even if they have to go into debt. And it doesn't make sense to me. I've got a tax client that always kind of struggling cash flow. Was trying to help him with that, but then he called this week and said, "Oh yeah, I went out to Vegas and I went to the new U2 concert at that new Globe or whatever it is. And tickets for that concert alone are over $1,000 for cheap seats." It's like, dude, pulling my hair out here, but people they just have this need to travel. So yeah, so Boeing, United, a lot of these could be good investments. It's odd that the airline companies' stock prices have not been doing well. Could be factors of higher employment costs, higher fuel costs, things along those lines. But they are expanding. They are building their fleets, maybe renewing their fleets, whatever that is. But it's interesting. Travel is still the one segment where the consumer is not slowing down. Revenge travel, good, yeah. So Chip, who put this comment out, he's actually a pilot with the airlines, so he sees it, and yeah, it's really something I can't explain. I don't know if it'll slow down when people are like, okay, we took our trips, or if people are just taking the approach, maybe after COVID, a lot of people think life's short. Let's at least experience that. I don't know what it is. So several low-cost airlines are seeing reduced demand, even though the upcoming holidays. I think air travel is going to scale back in the very near future. That absolutely could be. That could be. So, but yeah. So I end up going almost the full hour. Didn't think I would. Guess I'm yapping a little bit too much. Oh, good. Okay, one last point. Scott's got a great point here. Yeah, they have. So the 4% inflation rate is actually probably not real. You're probably experiencing higher inflation rate yourself personally when you go to the gas pump, grocery store, the things that you do on a daily basis. They have. If we measured inflation exactly the same as we did in the 70s and 80s, we'd probably still be near double digits. This is a whole lesson on itself, but the government has created what they call hedonic adjustments. So if you bought a computer 5 years ago for $1,000, and then today you buy a computer for $1,000, it's the same out of pocket for you. But what they say is the computer today is so much more powerful than it was, 5 years ago. So they adjust based on that. So they say, okay, actually the $1,000 you spent today, because it's a 50% more powerful computer, it's really only $500 for the inflation rate. So it does keep inflation in check, the official figure. And they're always tweaking it a little bit, so you never really know. But there is a site that it's called Shadow Stats, and they follow what's the inflation rate based on how they used to calculate it back in the 70s and 80s. So it's much higher. Okay, so great questions. In some of your questions, that's what I try to base a lot of this stuff on. And I'll try to get a little bit more into inflation for the next one, just to show you we're not out of the woods yet on this thing. And so that's why I think the Fed's probably going to keep rates where they're at unless something really breaks. And if things really break, it's funny, the market loved the fact that we might get lower rates, but if we really get lower rates, it probably means we're in a pretty deep recession. Okay, so I will talk to you all later. I hope you have a great weekend. Take care.